more momentum calls. This is how we keep people connected throughout the year with the Momentum Builder community. Remember that Momentum Builder is not an event. It is a community. The event is the place that we gather to share time together and learn together. So really appreciative of our relationship, Josh, of our relationship with Neo Home Loans, which you're the co-founder of, I believe. And it's been a really nice ride. You and Ryan have been real big givers and part of this community from almost from day one, or at least from the time we went big in Vegas. And it's been really nice. Really, really a pleasure having you guys join us. And I know that aside from being an originator for the last 23 years and doing over $1 billion in volume for helping people into homes, you've also authored a book, and you and I have had some really great chats about inflation. So I'm excited about today.
Me as well, my friend. What I respect so much about you and Dawn is that you guys bring together people who want to give to the mortgage community. And I was super impressed when I first talked to you guys and you were like, listen, we don't care. We're agnostic what platform you're on. If you can bring value and you can share abundantly with our community, we'll welcome you with open arms. And that's somewhat unique in this space. And I really want to applaud you guys for it. And I'm grateful to be here, and let's share some killer value today.
I love it. And I know you've thought long and hard about how this should go. So I don't want to drive it. I want to let you start it. I will say I'm wearing my very appropriate inflation shirt today for two reasons. One is it's appropriate to the conversation of inflation. Argentina has suffered some of the worst inflation in history multiple times. It's just kind of the nature of the beast over there. And today's the first day of Copa America, so I'm super excited about that.
It's a great setting, and I encourage you to jump in. I know you know a lot about inflation or are curious about inflation, but let me frame it up just a little bit, Gino.
Sure.
You know, I had the great privilege, if you will, to be raised by a single mother and in and out of the welfare system through my entire childhood, and had this real fearful relationship with money. And I say I had the privilege for that because it taught me some really cool lessons, and it created this ravenous hunger inside of me to understand money, to understand how it is that we couldn't put 3 meals in the fridge as a family and had to live in apartments and move every week. And yet I was growing up in downtown Los Angeles, and I would look up at these 80-story skyscrapers and I'd go, how in the freak did somebody come up with enough money to build this skyscraper? And we can't get 3 meals in the refrigerator. And so that curiosity for me really fueled my entire adult life, trying to figure out, how do I create more passive income than I have expenses? How do I escape the rat race, as Robert Kiyosaki says? And what are the major headwinds for me reaching financial freedom? And one of them, spoiler alert, is inflation, which we're going to talk a lot about today. And is it possible to use that inflation, which is the robber of your store of value, right? It's the destroyer of the value of the dollar and other currencies. Is there a way to use that trend that we're seeing towards my advantage? So that's what we're going to talk a little bit about today. And I'll just say one more thing. I think 2024 is an opportunity of a decade. And what I mean by that is, the last time that originators have had to set back their budgets, you know, kind of curtail their spending, was the Great Recession. And then we had at least a 10-year run where originators were making more and more money every year. It was only going to get better the next year. And our expenses kind of went up in line with our income for many of us, not everybody, but most of our budgets expanded. And it's very hard to pull back once you've increased your expenses each month, right? It's called lifestyle creep. To reverse lifestyle creep is painful and embarrassing in some cases. Well, we've all had to do that in the last 18 months. And now, hopefully, with what you've learned from the Momentum Builder events and all of the collaboration in this community and all your hard work, our incomes are likely going to go up in 2024, right? The ground's thawing, our pipelines are getting a little bigger. And we have a choice to make. We're either going to go back to what we did the last 10 years, which was as our income goes up, our expenses go up, or we're going to take that increased earnings and we're going to invest it. We're going to create wealth. We're going to create that financial freedom and hopefully create a bunch of passive income. So my goal is, and I mentioned this to you, Gino, Over the next 10 years, my dream is to help 1,000 originators escape the rat race, create more passive income than they have monthly expenses. And so this year, while our budgets have been restrained, as our lifestyle has pushed back, we have that golden opportunity to dominate desire and choose savings before we choose spending. So I'm going to turn it over to you and see if you have any comments there.
Yeah, I mean, look, first of all, thank you for sharing a personal story because I think that really helps us understand why you have a passion for this, right? Why is this important to you, right? When people say, what's your why or what's your purpose? Yours is clearly defined. There's no question about it. So I know that when people have passion for purpose that they're doing, things come out better, right? That's just the nature of things. And you know, as I was thinking about what you were saying, you know, you mentioned Robert Kiyosaki, and love him or hate him because he is a kind of polarizing dude.
Oh, for sure.
He does have some really great, amazing nuggets that you can live your whole life by. And the one thing I'm always trying to do is to get into the fourth quadrant, right? I'm always trying to invest. You said at the end, are we going to save? Shit, I don't save anything. I invest it all, which is sometimes kind of dangerous, right? Because I'm all in on investment and I'm always cash poor. I never have cash. I'm always in real estate. Every time I have $5 to rub together, I'm buying a piece of property, which in the short term is painful. But what it does is it assures that I don't spend those dollars unwisely. So is real estate the best investment on the planet? I don't know. That's arguable. It's been great for me over the last 22 years as an investor. I'm helping other people invest in real estate as well because I'm super comfortable with my skill set in the one area that I dominate. And I like it. I love it. I'm passionate about it. That's where I'm in my best place. And mortgage is kind of synonymous with it or adjacent to real estate investment.
That's right.
And what I'd love for us to do is to teach those that are with us so that they can focus a little bit more on the investor if possible, because investors do more transactions over the lifetime.
Yep.
That's it. End of story.
And what I want to teach today is something that is immediately transferable to our own personal investments. But, you know, it's like Jim Rohn said, that success is not something we pursue. It is something that we attract by the person that we become. And so I'm going to share with you a piece of information that is going to make you a person that attracts other successful people, because you're going to have an insight that most investors do not have. And when you can help share and educate something, you immediately transfer from salesperson to trusted advisor, because you just taught me something that I'd never contemplated before, and it's going to help me on my financial journey. So think of it in both of those contexts. How can this help me make better financial decisions for my own path? And how can I then use this to teach investors or somebody that's maybe contemplating selling an old home and buying a new home? And it's just a tool in our arsenal that every originator should have.
Love it.
So before I dive into this spreadsheet, Gino, would you just share with me the Argentina story of inflation, just real quick, because I think your perspective is a really good setup here.
Yeah. So the reality of Argentina, and notice I said multiple times, the problem with Argentina is it's full of corruption, from depending on what governments get chosen to be in. And since World War II, Argentina's pretty much always been leaning socialist, heading towards this socialist path where the government has incentivized its people to not work because they're going to get things for free. Yep. Right. So, I mean, it's really, they say they're a democracy and capitalist, but they're really not. And so what I've seen is over the years, government spending is out of control, absolutely out of control. And it's because every politician hires their 25 best friends, buys them all limos, gets them all drivers, makes sure that all their friends are getting what they get. And, you know, over 50 years, that's a lot of people that are depending on the government. And then when they had a crash, not too different than what we had in 2008 here, when they had a crash, the solution that the government had for the crash was to give everybody checks, even if they weren't working. Does this all sound familiar?
I was like, wait, are we talking about America or Argentina here?
Right. So the reason so when I'm watching what's happening here, I go, shit, I've seen this movie and it has a horrible ending. And so what ends up happening is you start adding zeros to your money.
Yeah.
You start adding zeros to your money. You start adding zeros to your money. And the only way the government can make the payments on the debt that it has to its people is to print more money. And you end up in this vicious cycle of devaluing your currency until it absolutely explodes. And in Argentina in the year 2000, it absolutely exploded for the second time. And they had to replace the current currency with a new currency. So that's what happens. And you refresh and you start with a new currency and you trade in your old currency for 30 cents on the dollar, and the government just refinanced all its debt and started over. That can happen here, guys. Yes. Let's not be ignorant to the fact that it's happened before.
And it has happened 100% of the time with every fiat currency going back to the time of Babylon. If you study what happened in Rome, if you studied all of those empires died because of an overspending of the government, an overprinting and watering down of the monetary system, and eventually you have a runaway inflation and the society kind of implodes and then has to rebuild. So if you go back thousands of years, that's the story. It happens 100% of the time. I'll share my screen and kind of jump in here, Gino. But there's as you were talking, I was just Googling this quote. This is from Voltaire. I think this is in like the 13th century, 15th century, something like that. And he said that paper money eventually returns to its intrinsic value, which is zero, right? So this isn't anything new.
I just got goosebumps on that. That's so real.
Eventually, that's where it goes. So I'll jump in and kind of run you through how some things that I've learned about inflation that might blow your mind and how I'm using it to my advantage. Ultimately, I'm going to show you how to short the US dollar, which means I'm going to show you how to make money as the value of the US dollar continues to decline. And if you can teach investors how to do that, trust me, you will have their admiration and respect. So Adam Smith said the problem with fiat money is that it rewards the minority that can handle money, but fools the generation that has worked to save money. All right, well, let's see how that plays out a couple hundred years later. By the way, what's fiat money? Just for everybody who knows, it's a government-issued currency that is not backed by a physical commodity such as gold, silver, but rather by the government that issued it. So it's the full faith and credit of the U.S. government that's backing that, not oil, not gold, not anything else. So this is
just to jump in really quick there.
Please.
Confidence in the money
is
the most important thing.
Yes.
The only reason it's worth something is because we believe that it is.
That's right.
That's a 2 cents.
It's the faith and credit. But when your national debt goes up $1 trillion every 120 days, you start to lose that faith and credit. And that's when you're potentially in the death spiral. So this is the distribution of household wealth. And again, Adam Smith said this hundreds of years ago. Let's see how it's panned out now in 2024. So what I want to point out here is that the bottom 50% of the US population, down here, 50%, they only control 3% of the wealth in 2023. Think of that for a minute. There's approximately 175 million people that only control 3% of the wealth in the United States. And if you look at the bottom 90 or the 90% of the population, that would be a cohort of approximately 315 million people. They only control 31% of the wealth in the United States. That's crazy. Well, actually, I'm sorry. It would actually be 31% plus 3%. So it'd be 34%. What that means is that the top 10% control 66% of the wealth in the United States, and the bottom 90% of Americans only control 34%. This is in living color in 2024, exactly what Adam Smith hypothesized about in his quote, that rewards the few that can handle money, but it fools the entire generation that has worked and saved money. So let's walk through and get a little deeper into what's happened with inflation in the United States. So back on August 15th, 1971, President Nixon announces before the nation that he has temporarily suspended the convertibility of the dollar into gold. Prior to that date, foreign nations could take their dollars to a Federal Reserve Bank and turn them into gold coins and walk out with coins. It was convertible for gold. It wasn't a fiat currency prior to this. It was backed by an actual asset. That date, 1971, really changed everything for our country. If we look at what the cost of living was back in 1971, you could buy a new house for $25,000. You could buy a car for $3,500. You could send your kid for an entire year of tuition at Harvard University for $2,600. By the way, look at what incomes were. Incomes were only $10,622, and that'll be relevant as we move forward. So this is a chart of inflation going back to 1913, which is when the Federal Reserve was founded. And you'll notice that the inflation was fairly flat from 1913 through, right about 1971, when we left the gold standard. You see, we had 284% inflation over a period of roughly 60 years, which means that your costs are doubling roughly every 20 years. So look, a piece of candy went from 5 cents to 15 cents over 60 years. Yeah, there's a leak in the bucket. There's a little bit of inflation there, but it's not massive. Well, from 1970 through July 22, and that's where this, unfortunately, this chart ends, you saw an additional 2,600% inflation. 2,600% inflation over the last 50 years compared to about 300% inflation over the previous 60 years. So when we went to a fiat currency, inflation went absolutely crazy. And think about that for just a second, Gino. In 1970, we could take our family out and buy them a dinner for $10. And today, that same dinner with 2,600% inflation would cost $260. It's crazy. That is the debasement of a fiat currency. Well, let's look at a few other kind of important mile markers here, and I'll go through this quick. But this is the adjusted monetary base. This is how many dollars are in circulation in the United States. And you can see as the government continues to take action, we start to see money supply grow. And from 1920 to 2020, in 100 years, the monetary supply grew by 55,000%. 55,000% increase in the dollars in circulation in the United States. And that's what's leading to all of this inflation.
I don't want to totally go down this rabbit hole, but I do want to mention that partially one of the culprits of this is when you digitize a currency and it starts to become more digital, it becomes more liquid. And when it becomes more liquid, the velocity of money starts to change. And so as you exacerbate the money supply, if you change the velocity, it's magnified 55,000% in this case. So you have to be really careful when you put a lot of money supply into the system. You have to really monitor the velocity of money. And so when you added credit cards, I believe that some of this, what you're seeing is really reflective of credit cards.
Yep.
Because those aren't real dollars. There's no gold backing it. There's basically a bank says, sure, I'll lend you money. And they're allowed, now they're more limited with Basel III and the things that are happening, but they were at one point lending $30 to $40 for every dollar they had in deposits. Talk about leverage.
And you wonder why we're headed towards a US digital currency, which is starting to be beta tested. And you're seeing more and more places not accept cash. That's because banks are making it harder. This all leads to inflation, and we're going to get to who has to benefit from the inflation here shortly. I bet you could take a pretty good guess. Again, Gino, you alluded to this in Argentina, but this is federal debt. This is the amount of dollars that the U.S. government owes. And back in 1971, when we closed the gold window, when Nixon closed the gold window, the federal outstanding debt was $412 billion. Well, today it's edging towards $35 trillion. So we're borrowing more dollars. We're putting more dollars in circulation. All of these things, as you alluded to, Gino, add up to inflation. And look at the compound effect this has on somebody's retirement account. So in 1971, if I had $1 million Guess how many dollars I would need today to have the same buying power as I did in 1971?
I'm just going to go quick. I'm going to say 22 million.
Close, close, a little less.
A little over.
$7.7 million in cash in January 2024 has the same buying power as $1 million in 1971. You have lost 87% of your purchasing power since 1971. If you've had money under the mattress or in a can out back, and that's why Gino says with his background in inflation from Argentina, he's trying to get out of dollars as soon as humanly possible and put it into some sort of an asset like real estate that at least keeps up with inflation so that you don't have this 87% erosion of your life's energy.
And I will add one more thing to it. Hard, tangible assets, not crypto, right? Not necessarily the stock market, which is volatile as all hell. Tangible assets. I like real assets, bars of silver, baseball cards, pieces of gold, whatever you fancy, something you can touch.
I think that's a common theme with anybody who's been exposed to a culture that has had that runaway inflation, because it's the only thing that survives that recast of the currency as you described. Everything else gets demolished. Okay, check this out. This is such a mind screw. So we all know that home prices are expensive, right? They're more expensive than they've ever been. Housing has to bust because it's so expensive, we hear. Okay. Well, that's true if you are measuring the value of a home in dollars. But what happens if we measure the value of a home in another currency, something other than, or another asset other than dollars? So what you see here is the green line is the cost of housing going back to 1953. And you can see that line goes from left to right up. The blue line is gold. And the red line is the home to gold ratio. So I'll kind of walk you through this. Back in 1953, your median home price was $18,100. Gold was $35 an ounce. And if you divide 18,100 by $35 an ounce, you needed 517 pieces of gold to buy a home back in 1953. Fast forward to today, median home price, $388,000, gold at $2,000. Today it's 2,300-ish. So it's gone up another 15% since we created this, which means you only need 190 pieces of gold to buy a house. So wait a minute. In 1953, I needed 517 pieces of gold. Today, I need 190 pieces of gold, but I thought home prices were more expensive than ever. Well, are homes expensive or is the dollar weak? You see, most people think that if you've invested in gold, you've done exceptionally well. The price of gold, the value of gold has gone up. So in 1950, you had a $35 an ounce. Today, gold, $23.81. This was a couple of months ago. So you'd say, wow, this person got rich. They really did well in that investment, except that
you're going to put the inflation slide right on it.
Yes, sir. Yes, sir. If you go back to Roman times and you study what the senators wore into the Senate and into the Colosseum, they wore Roman toga suits. And a Roman toga suit 2,000 years ago, more than 2,000 years ago now, was the cost for a fine Roman toga suit was 1 ounce of gold. 1 ounce of gold is what it costs for a fine Roman toga suit. And today, if you go into Nordstrom and you buy a nice suit that you would see a senator wear on the Senate floor, the cost is about 1 ounce of gold. 2,000 years later, you get the same amount of exchange or purchasing power from an ounce of gold. So did gold go up or did the value of the dollar go down? So here's Voltaire's quote: the paper money eventually returns to its intrinsic value of zero. And if you go back to 1950 and you had $100, today that $100 would only have the same buying power as $7.50, meaning that you have lost 92.5% of the purchasing power of your dollar over the last 70 years. 92.5% of your life's energy savings, if you saved in dollars, has been robbed by inflation over that period of time.
You are going to have a happy ending to this, right? Because it's getting kind of depressing.
I know. This is I call this a monetary magic carpet ride, and it does land safely on the other side. But
Okay,
yeah,
good.
I'm with you. I'm with you. All right. So the moral of the story, we're all getting screwed by inflation. And the longer a period of time you zoom out, the uglier it gets. And the problem is that from my perspective, I only see this government spending more and borrowing more. I don't see any path for them to get back to fiscal responsibility. So if that's the reality, I can either begrudge it and hate it, or I can adapt to it and try to learn how to use it to my advantage. So I'm going to share with you something that I learned from a gentleman by the name of Jason Hartman. Do you know Jason Hartman? Have you ever heard of him, Gino?
Heard the name, but I don't know him.
He was a realtor in the Southern California world, did exceptionally well, started buying a ton of investment properties, and then said, this realtor stuff sucks. I'm just going to go be a real estate coach. And now he coaches people all over the country about real estate investing. And I had him on my podcast. Oh, Ryan McDonald, right on. He knows Jason. He's a really good dude. And he taught me something that changed my life. I went on to acquire 8 commercial buildings between 2018, when I interviewed him, and 2022, almost completely based on this advice that I learned from him that completely blew my mind and altered my trajectory. So this is a little nuanced and a little detailed. Please stick with me. I'll make it as easy as I can to understand. So what Jason introduced me to was a concept called inflation-induced debt destruction, which is too complicated for most people to understand. So I just say inflation destroys debt, okay? And so let's walk through this case study. So this is, and I believe Jason told me this was a story of the home his mother bought. So this was like a real case study. The value of the home in 1972 was $18,267. The mortgage amount was $14,614 in this case study. The mortgage rate was 7.37%. The mortgage term was 30 years. The monthly payment was $100.88. The annual payments are notated here at $1,210 a month. She had an 80% loan to value, and we assume her tax rate at 33%. So these are the assumptions for this analysis. And what Jason points out in his inflation destroys debt scenario is that each year, as inflation erodes the value of the dollar, it also erodes the value of the debt, because you've borrowed those dollars today in today's dollar's value, but you're paying them back with 30-year futuristic dollars. So this is the inflation rate for each year over that 30-year mortgage. And this is the value of the dollar. When she borrowed the money in 1972, the debt was the same value as the dollar in that year. But each year, as inflation devalued the dollar, it devalued this is just the devaluation of the dollar over that 30-year period. So check this out. She bought the house in 1972. A dollar got you $1 worth of goods and services. Just 10 years later, in 1981, because of inflation, a dollar only bought you 46 cents worth of goods and services. Does that make sense so far?
Absolutely brutal.
Brutal. And at the end of the period, you only had 23 cents of buying power back at the end of the 30 years. So in nominal terms, and nominal terms means in name alone, in name alone, she made a $100 payment a month, $1,210 a year for the entire 30 years. That's the dollars that left her account. But the value of those dollars went down every year because of inflation. And I'll bring this all home for you if it doesn't make sense. Don't worry, I'm going to land this plane. So this is the inflation adjusted payments. You might hear people talk about in nominal terms. That means in name alone. So in other words, Gino, in 1920, what did they call a $100 bill?
$100.
And in 2024, they still call it $100.
Right.
But is it the same?
No.
Hell no.
You have to measure it against what you can get with it.
That's exactly it. So you have what's called nominal terms, which is in name alone. And then you have what's called real terms or inflation adjusted. So each year as inflation devalues the dollar, the inflation adjusted payment goes down. And then you also have to factor in the tax benefit of her having this mortgage. So let's get to the punchline. Over the 30-year period, in nominal terms, she repaid the bank $36,317, which was her principal amount of $14,614 plus the interest over that 20 years. But in inflation adjusted real terms, she only repaid $16,392. And then in after inflation and tax adjusted payments, she only repaid $12,654, excuse me.
One thing I want to point out, because that sounds pretty good, right? You're like, wait a second. So you're saying I actually paid less in inflation adjusted dollars than the money I actually borrowed.
Inflation and tax adjusted repayment is less than the amount you actually borrowed 30 years ago.
Even at 7.37%.
And that's why people might be interested in this information today. So the question,
me up. I had to bite.
Yes, thank you. So the question that people have when I show this slide is, what does this mean? What does this mean? Her nominal payments were $1,210 a year, $100 a month, but it feels like she's paying less and less each month. Why would it feel like she was paying less and less each month? Well, let's look at what happened to salaries. You had annual individual salary average in 1972 of $7,133 per month. By time she paid off this mortgage in 2001, the average annual salary for an individual went to $32,921. So my mortgage payment was the same. My mortgage payment was $100 a month, but my income over those 30 years went from $600 a month in income to, what would that be? That would be $2,600 a month in income. So if I have $600 a month in income and $100's going to my mortgage, that's a significant cost to me. But if I have $2,600 a month coming in income and I'm still paying $100 out to that mortgage, it is insignificant. And that is how inflation destroys debt over long periods of time. I'm going to give you, let me actually give you a spot to interject, and then I'll share one more summary screen.
Yeah, I wanted to mention right there one thing. What you just described is something that everyone on this call has heard, but maybe never saw it in practicality.
Yep.
When we tell people that a house is a hedge against inflation, that's how you demonstrate it. That is the best way you could ever demonstrate how a house is a hedge against inflation. Because and it only happens in the United States and countries that have fixed mortgages.
That's it.
Okay? This is a huge thing to know, because other countries in the world do not have fixed mortgages. They only have 5-year or 7-year loans that get refinanced all the time. And what that does is protect the banks. But this is the only country, other than I believe Switzerland, that has a 100-year mortgage, a 100-year fixed mortgage. You have to pass your house down to multiple generations to pay off a mortgage in Switzerland, because the houses are so expensive. So if you ever think, how are we going to fix this problem? Add more years.
Yeah. Yeah. Well, and the converse to that is the opposite of being the homeowner that has a mortgage that is destroyed with inflation over a long period of time is being a renter, which is like having a 1-year fixed adjustable mortgage, and every year your payment goes up into forever, right? So we have to contrast the advantage we have versus the disadvantage that the renter class has.
I might put together a marketing slide on that. You know, how's your 1-year adjustable mortgage feel? And send it to a bunch of renters.
Not good. Not good. Not good. All right. So here's the summary again. And if there's questions, I'm happy to answer them. If anybody wants to interact and throw something in the chat, I appreciate all the emojis and reactions. So here's the summary, right? Gino kind of stole the punchline. Original mortgage size, $14,614. In nominal terms, she repaid $36,000 at 7.37. But once you adjust for the cumulative inflation over that 30-year period of time, she really only repaid $16,393 in real terms, which means her inflation adjusted interest rate was 1.06%. But then we have to factor in her tax deductibility, which means she only paid back $12,655 on a $14,000 loan, which means her after tax and inflation adjusted interest rate was negative 1.16%. So why in the world would you ever pay off a mortgage early if you didn't have to? It's like shorting the value of the US dollar.
Yeah, I think about and I have a unique strategy as it relates to me. That's why I don't care about interest rates at all. All I care about is recovering tax-free dollars from the equity of my home as often as I possibly can. So whenever my properties go up in value, I refinance them and I take the cash out because I still get the appreciation on what the value is, irrelevant of what the mortgage note is.
Right.
And every time I take money out of that house, those are tax-free dollars. A loan is the only way. This is a Kiyosaki thing too.
Yep.
A
Yep.
loan is the only non-taxable dollars that I can put in my pocket. And taxes are a big deal. If you've never thought about it this way, for every dollar you actually have to spend, you have to make close to two. So
Right.
that relationship between income and taxable dollars means that you have to focus just as much energy on tax avoidance as you do on earning income. And a house is a great way to do that.
100%. Yeah, I mean, Jason Hartman has a strategy he calls refi till you die. And essentially, it's that same thing. Hey, I want to buy more property, or I want to make an investment in another business. I'm not selling something out of my asset base. The game is get the asset base as big as possible so inflation can push up those number of dollars while inflation devalues the debt. And I'm going to borrow against that asset that has a good cash flow, pull some of that money out, buy another asset that has cash flow. Hopefully I've increased my cash flow situation, or even if it's neutral, I've increased my asset base. That's exactly the advice that Jason Hartman would give.
Spot on. That's exactly how I've lived my investment life for the last 20 years.
Ditto. Okay, so speaking of that, man, that's a great tee up. We just went from something that was hypothetical, right? Jason Hartman's mom's mortgage story. Let me show you a real life case study of a property that I purchased 23 years ago. And I'm going to show you in real life as an investment how inflation destroys the value of debt. And I think this will really bring it home for people. So this is Capitol Hill Villas. It's an 8-plex that I own my mom and I own together. We're real estate partners. And we purchased that property in 2001 for $315,000. So 315,000 divided by 8, we paid $39,000 a unit for 900 square foot, 2-bedroom apartments with covered parking and have an incredible view of the entire downtown Salt Lake and the Great Salt Lake. It was, in retrospect, at the time, I thought I was overpaying and I was scared to death. In retrospect, 23 years later, it was the buy of a lifetime. The average rent was $300 a month for those units, which means that I had $2,400 because $300 a month times 8 units is $2,400. So the annual income was $28,800 per year. The mortgage payment, because I financed the entire $315,000 at 7%, I did a seller finance deal. We had saved about $50,000 in cash, and we decided to negotiate 100% financing from the owner. And then we put our $50,000 in renovating the units. My mortgage payment was $2,096 a month. So I've got $28,800 in income. Divide that by 12. I've got $2,400 a month in income and $2,096 in payment. That is so my annual debt service was 25 grand and my annual income was 28,000, which means I had negative cash flow for the first 5 years. This did not feel like a very good deal for the first 5 years. I was changing toilets. I don't know if anybody has gotten that waxy poop stuff on the bottom of toilets on their clothes. It's quite the experience. If you haven't done it, you should really do it. It's fantastic. But I was hating this investment for the first 5 years. I thought,
you call Mike Diamond every time.
Oh, dude, we couldn't afford. I mean, I was doing the landscaping. I'm upside down painting the ceilings. Like my mom and I did everything. I found her. This is no bullshit. I found her at 10 o'clock on a Saturday night, Sunday night, excuse me, pulling out the staples because there was carpet over these hardwood floors. She's pulling out the staples because we had a company coming in the next day to restain the floors. I mean, we did everything, dude. It was brutal. All right, happy ending. Remember, I've got $28,000 in income, 25,000 going out in mortgage. This is a very painful investment. Fast forward to 2024. This is real. Please don't call these renters to try to get them to buy homes. By the way, I should have probably X'd those out of here. This is a real rent roll. We have income now of $12,650 a month. We times that by 12 months. That means that you've got income of $151,000 a year compared to 22 years ago. We had 28,000 a month in income. But here's the kicker. The mortgage payment stayed the same. Actually, we've refinanced it 3 times and the mortgage payment has actually gone down. We just recently pulled some cash out for another investment, but the mortgage payment of $2,000 a month stayed the same until we refied. But the income went from that $2,400 a month to $12,650. So if you think of it from like a debt to income perspective, we now have a 16.5% payment to income ratio. When we bought the property back in 2001, we had about a 90% payment to income ratio, give or take, maybe 85% payment to income ratio. So that's how, as inflation pushes up rent, as inflation pushes up annual incomes, and the mortgage payment stays the same, that's how inflation destroys debt.
I love it, Josh. In fact, I want to make sure that people watch this over again because we covered a lot. I mean, we still have a little bit of time, but we covered a lot of stuff. And be able to elaborate this to your clients. If you're able to elaborate this to your clients, especially first-time home buyers, do you think they'll be more confident in the decision they're making? Like, this is the hardest, most scariest thing they've ever done in their lives. And you're saying, don't worry, it'll be fine.
Yeah, you
Sonia. Yes.
Nailed it. Nailed it.
We have a thing called Renters Revolution. I think we're going to pass that out at the next thing called Renters Revolution. We do first-time home buyer seminars, which you guys should do right now. They're working. We're creating loans by doing first-time home buyer seminars. Believe it or not, that's actually a working strategy in today's market. It's been like 10 years, 12 years since you could possibly do that and effectively, but it's been working for us.
Well, I would say that first-time home buyers are feeling more fearful and more insecure than ever, which means on the other side of that, we potentially have more value to provide forever, right?
Yep.
All right, I'm going to wrap this up with 2 more slides and then we can take questions or dialogue or whatever. But the question, that I ask myself is, it sure feels like the government is fostering and encouraging this inflation since 1971. So follow the dollars. Why would that be? Why would the government want inflation? Well, if you look at the percentage of world debt across the entire United States, across the entire world, you see that the US has 34.21% of all of the global debt in the entire country. This is government debt. So you see that if inflation destroys debt, who's the number one beneficiary? The United States. The United States. So it's not an accident that we have this level of inflation. The number one beneficiary is the United States. I just simply want to align my investment strategy with the strategy that's going to behoove the US government. This is the only way I know how to short the value of the US dollar, which is borrowing US dollars fixed for long periods of time and then letting inflation devalue that debt over a long period of time. I created one other thing real quick I just want to share with everybody. You can go to this URL, debtdestroyer.bravesite.com, and I'll go ahead and drop it in the chat here in just a minute. And I created a calculator that you can all use with your customers. So let's see. You see my screen here, the Loan Atlas
Yeah,
screen?
looks
Okay,
great.
cool. So check this out. If you go to this URL, which we'll throw into the chat here in just a sec, you'll come to this page and you can throw in your mortgage amount. This is variable. So let's say it's 400,000. And let's say you've got 25 years left. I don't know, payment is 2750, principal and interest. And then this says this will calculate an annual inflation rate. You can just click into the source here and it'll actually show you what's the cumulative inflation from 1971 to 2024. And you can put in that factor. Inflation rate 3.94. Cool. So we go back to here. I type in 3.94%, and we say, and then let's just say their interest rate is, I don't know, let's say 4%. Well, what's the actual cost of that debt? In inflation adjusted terms, they're going to pay $508,000. So your inflation adjusted interest rate is 0.06%. So I don't know, should you sell that home or should you turn it into a rental? Or maybe you want to use this relative to today's rate and your rate's going to be 7.5. What's the after inflation cost of that debt? Oh, it's only 3.43%. Doesn't seem so bad now. Gino, anything you want to add there?
Oh, I mean, I think these are the tools that we need to use, and I'm glad that you guys have that on Loan Atlas because you want to educate and empower our consumers. They don't have a good place to learn. They don't have a good source of information other than us. That's our job as the modern mortgage advisor to be able to put that in their hands. Lost you there for a second. You're back.
Yeah, sorry. I'm back and I'm just dropping in that URL into the screen. You got me now? Am I clear?
Yeah, you're good.
Cool.
I do want to. I have a really good question in here that we want to touch base on here. It says, how does this work with reverse mortgages? I really think we should address that because a lot of people are still afraid of reverse mortgages. I wish I could get one. I would get one today if I could. I think it's a wonderful tool, but just how would that apply?
Well, you essentially have a debt that is increasing versus being amortized down, right? But inflation does the same thing. It continues to push the property price up. It continues to push presumably the wages or income of that retiree, depending on what their income sources are. Certainly if they own other real estate and have passive income up. But inflation destroys debt, all types of debt. It just is better suited to destroy fixed rate debt because the fixed rate payment over a period of time becomes more and more nominal or insignificant as income goes up. There's no payment on a reverse mortgage. So I don't know. That's a question I'd probably have to contemplate and sit with for a little bit. What
Yeah,
thoughts?
I would say I'd dig into the part where, I like the line of credit because it tracks inflation and it's basically giving you a return.
Correct.
The same amount of if your interest rate is 7%, we can go way into the weeds on this, but if your interest rate is 7% on a reverse mortgage and your line of credit is going up by 7%, you're effectively receiving those dollars when your line of credit goes up. So the younger you can get one and that line of credit continues to grow, the line of credit will never outpace the value of the home. So you're protected in that.
And Gino, what people don't contemplate when they think about, well, I'm losing equity in my home. Yes, your home value is going up, but your mortgage balance is as well if you don't make a payment. But that means that you're not sacrificing dollars out of your retirement account, or you're delaying your Social Security benefits, which increases the payout over time if you need it later versus today. And since you're not using those dollars, those assets are going up and likely going up faster than what your indebtedness on your house is. So it's really, I think the reverse mortgage is a masterful tool to help people with financial planning.
This kind of brings us full circle into a question that Deb asked. And Deb, you can come on with us if you want. Sonia, if you want to promote Deb. She asked earlier about using a whole life policy as a family bank. And we're going to go over today. I hope everybody's okay. Obviously, you can bail on us if you have to at the top of the hour, whoever does. But I could see already that we're probably going to go over a little bit. Josh, do you have 5 or 10 to stay on or no?
I'm good. Yep, I can stay on another 5 or 10.
Okay, so I think that, oh, she's driving. Okay. I think what's really important as it relates to family banks and whole life policies, think about this. I mean, yes, ideally a whole life policy you'll get as young as possible so you can get the compound gains over time, right? That's the number one thing that you want to make sure you're doing if you're using a whole life policy strategy. But if you don't, and let's just say you're looking at a reverse mortgage, then you say, well, I still have the means to make a payment. Now you make the payment into a whole life policy, and I'm not giving tax advice, but inheritance dollars to people from your life insurance are non-taxable.
That's right.
So what you want to do is you take those dollars from a reverse mortgage that you, instead of making a payment, you make those payments into a whole life policy. And then when you die, your heirs will get life insurance tax free, and that'll give them enough money to pay off whatever's left on the mortgage. And then they have a property that's free and clear. So you can still leave your family a free and clear property. You just have to use a different tool to get there.
And your cash value is growing at somewhere around 4 to 5%, which could be a cash distribution machine. So not only have you effectively, I'll use the word laundered the money so that it's a tax-free inheritance, but it actually creates a cash flow for you over time as those dividends can be paid out to you.
And one more add-on on that. You can also borrow from these policies and still get a return on the actual principal balance, just like you would on a home. You still get the top dollar watermark appreciation, even though you've borrowed dollars out of the bottom. That won't be in the inherited value. It takes it away from the death benefit, but that's another way to get tax-free dollars. So remember, tax avoidance is important, not tax evasion. Don't do that. Tax avoidance, tax strategies are important because they're worth just as much as income gaining strategies.
And Gino, that brings up asset allocation. So I'd love to just touch on that really quickly. I want to just drop one thing before I do into the chat for everybody. And this is a workshop that Tim Brahim and myself and a few other Loan Atlas folks are going to put on next week. So I just wanted to share it with anybody. Tim's going to do a business planning workshop for free, June 25th, 9 a.m. Pacific time. And he's going to teach you his entire business plan that he created when he was an originator. He originated over $1.3 billion in his days. And that was when the average loan size was a lot less than the average loan size was today. And he's basically going to walk you through a 75-minute step-by-step. So anybody who wants to come and generate more income, because I'm aware you have to generate income before you can save income, I just want to make sure that we invite you to that before you leave today. I've left the message in the chat. Thanks for letting me share that. Let's talk a little bit about asset allocation. So my personal holdings is I have 85% of my net worth in real estate. That's real estate equity. All of those properties, almost all of those properties, 95% of the properties that I own, we have 166 tenants. So 95% of those properties have mortgages against them, and they're fixed for as long a period of time as I can. But the equity that's in those properties equals 85% of my net worth. I have 5% of my net worth in gold, silver, like, the stuff in your safe. I also own some gold stocks for diversification purposes. I have 5% that is in money market accounts. It's like T-bills and those types of things. And that's just liquidity. I know I'm losing the value on those dollars, but I like to have something if I have a huge vacancy in one of my commercial buildings that I can make the payment for 6 to 12 months and I'm not freaking out. So those business accounts that hold that real estate invest in treasury bills that are paying 5%. And that's 5% of my net worth. And then I happen to be a fan of Bitcoin, but I'm a believer in its future because it's fixed and it won't continue to expand like the monetary base. But I only have 5% of my net worth there. So I think I see where people make the biggest mistakes, Gino, is they don't have some sort of diversification. So if the market goes left or the market goes right, you don't get wiped out because of that shift, because you can start to feed off of or use your savings in those other asset classes to survive. So do I think that the life insurance path is a fantastic strategic planning path? Yes, but I see some people who do that with 100% of their savings. I wouldn't do that. I would think of it as buckets or quadrants. And what's your comfort level? Do you want 25% here, 25% here, 25? You got to figure that out for you. But don't make the mistake of going, oh, Bitcoin's going to 1 million. I'm going to put 95% of my net worth there. You want to have that spread out. And as Gino said, you're probably better off having that spread out along asset classes that you have some sort of insider knowledge, which all of us real estate folks, we have insider knowledge on how to make private money loans. We can be the bank. You can do that through your life insurance policies. And we have insider knowledge on real estate.
I mean, I think, Josh, you absolutely crushed it today. I am going to think we can wrap this up almost on time. That's awesome. But we covered a bunch of stuff. I mean, this is one of those. I mean, this is like a highlight reel, Josh, of something that we should watch and rewatch. And what we'll do is we'll clip this up into a couple of social pieces because I think there was like at least 4 or 5 reels that we can get out of this thing. It was awesome.
I love your marketing brain, and there's no doubt why you are as successful as you are. Thank you for having me on, and I hope this was valuable to everybody.
All right, everybody. I want you to please be on that Loan Atlas webinar. And if you're not able to get on that webinar, check out Loan Atlas because you guys are doing great things for us, just like we're trying to do with the community of Momentum Builder. You're bringing a lot of knowledge. And I know Tim's a wealth of knowledge too. And Tim's just has this like Zen, right?
He's
like
the Jedi Master, man. I don't know. I don't know how else to explain it.
Yeah. Hey, look, there's Deb. Hey, Deb.
Thanks, Deb. Appreciate the kind words. Thanks for being here.
Driving, but I just saw her pop on. Maybe she could say something. What else do we got? All right, next week I'm not going to be here. Don's not going to be here. But we've got Candace McNaught and Rachel Brown, both, I believe, well, at least Candace is with Supreme Mortgage, and they're going to be on with Sasha Stair. Sasha's been amazing to Momentum Builder. She's our co-host. She's helping host while we're not available. And then the week after is Social Coach. So if you're still struggling with social Coach is what I'm going to say is an easy platform for you to get better at.